Welcome back to the channel. As always, if you copy trading, you're an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to look today at a stock called Triumph Financial. The ticker is TFIN. So 2 billion market cap company, sector in financials. I would argue that they're not really a bank, but we'll get into that in a second. And their valuation from a next 12-month PE standpoint is 17, almost 76 times multiple. So what do? So they provide payment services. So that includes banking, factoring, which is essentially selling your invoices at a discount to get paid now as opposed to 30, 60, 90 days down the line. And also payments. They're particularly big in freight and truck, which we'll look at in a second. But also they do other things such as checkings, saving accounts, money market, and certificates of deposit. They're also involved in commercial real estate. But really, the most important part for them is the payments product. So, as we can see, the stock has been on a really nice option for a while, especially during the 2021 and 2020 period. And of course, as many sectors did in 2022, they struggled quite a bit, but they started recovering since 2023. It's been quite a gradual decline, but you can see that the trend that they're in at the moment is definitely strong. And I think one that not only will continue, but also will accelerate faster. Why is that? Well, back in 2022, around this time, the freight industry, which is massively important for them, was struggling. It is still struggling, as a matter of fact. What you saw there was average invoice sizes dropping from, say, $2,500 to about around $1,800. And also, we were having a lot of issues with inflation. There was a lot of overcapacity in terms of freight transport in the market, which is still the case. But also rising interest rates impacted the lending profit of the company. So for example, this for them resulted in commercial loans that were on their books to be adjusted. So for example, because they were variable, those loans, they had to adjust the interest rate from 10% to maybe 6.5%. And the deposit costs also went up, decreasing their net income margin. There was also pressure on their commercial real estate portfolio, which is again a massive problem that took place in the last couple of years. Now, the freight industry, if we are to specify into one of those areas, has not recovered yet. The company claims that approximately 15% of capacity still needs to leave the system. And that's because there are still out there many small carriers that are operating at a loss. And that partly, at least that's what they claim, is because a lot of private equity and VC firms are backing them to inundate the system with capacity. There are also other things that are still a headwind. The spot rates need to improve above the carrier cost of capital, which, as we said before, is still ongoing. And there needs to be a better balance between supply and demand. So all in all, big headwind here, stock drops, and then it starts to recover. What's been happening since, and why is the stock going up? The company has been focusing on improving their operation. They've spent their efforts in building network density, which just basically means getting as many freight transport deliveries in a specific geographic area. That enables for higher pricing, drives up their operational efficiencies, and also makes them more competitive, creates that competitive mode. And as part of the process, they have achieved 47% in terms of brokered freight, right? And they also see as a milestone to be hit by the end of this year to reach 50%. And beyond that point, they think that between the range of 50 to 80 is going to be a transformation zone for them. And the reason for that is because, as with other business models that you see out there, this becomes a matter of economies of scale. So you build that infrastructure with a fixed cost, right? And once you go beyond that tipping point, then you capture all the upside with a relatively fixed cost base. So that's, in my view, part of the reason why the stock's been rewarded. Because if we look at the valuation, let's look at the multiple here. We saw how the stock price went down, right, since the beginning of 2022 all the way till early 2023. And that makes sense because the valuation, which reached its peak around that time at around 32 times multiple, went down all the way to a low of 15. So in other words, it halved. But look at what happened then. Even though the stock has not recovered its all-time highs, the valuation has gone all the way from that 15 to the current 75. So the market is clearly betting that either this stock is massively improved the quality of its operation, and perhaps as well pricing that the industry is starting to turn around, right? Now, if we have a look at market commentary on what's happening, they have had some interesting developments in their products. So there is one particularly that is called TriumphPay. That's the payment business. And the CEO mentioned in one of the earnings calls that they are EBITDA margin positive, notwithstanding a freight recession that's causing many companies to go bankrupt. Now, this is a massively important part of the business because one is driving at the moment a significant part of the revenues, and two, because in terms of that EBITDA portion, they are currently at some low profitability, but they have set the provisional target, the interim target, to reach 25% EBITDA in 2026, with the objective of reaching 50% long term. So we're looking at a 35% improvement in the near term, with an even greater upside down the line. So that's one of the big drivers, in my view, that is going to propel the stock going forward. And why now? Well, management expects significant improvement in 2025, but also a transition period for them. So I mentioned before the density, which is something that they're building this year and also next year. And their plan is for the monetization of this part of the business to follow after that. So they want to prove their clients their value first and then monetize that gradually. They're also launching new revenue streams and scaling existing initiatives. So I mentioned before the TriumphPay. And that business at the moment is sitting at around 55 million in revenue. So they want to scale that to 100 million next year in 2025 with a view of reaching 1 billion long-term target, right? So that's like a 20x. Okay. So we mentioned before how freight rates are a headwind at the moment. But if we look at some of the expectations for freight rates that are being released, I found a very interesting report that I'll share with you in a second. So you can see here that the freight rate forecasts for dry national van are reaching a tipping point here where they have been steadily decreasing since 2023. And now, as we enter Q4 of this year, that trend is reversing and accelerating down the line. That's the expectation from Arrive Logistics. And a similar thing happens for the reefer national rate. So to me, that's an indication that that trend is starting to shift to downside, and that's going to be a tailwind for the company, of course, which is again now in a much stronger position operationally to deliver better results. We also mentioned that there's overcapacity at the moment in the market, and the report that I just showed you touched on not only the bottom of those rates having reached a floor and now recovering, but also management came with the commentary that eventually players will realize that the capital allocation that is being put out there is not productive and will eventually exit that sector, bringing down that overcapacity. So for the time being, management are deliberately choosing long-term value creation over short-term profits. And I know that's boring for us as traders, but that work's being done already. And now these guys are in a position to capitalize that upside. They're also building that network, and I think those efforts will start to show in the coming months. As a matter of fact, management expects that good part of their revenue would be realized in the second half of 2025. They have also improved their balance sheet and they have remained profitable. So if we look at their numbers, right? So you can see that 2023 wasn't a good year in terms of revenue, neither net income margin, and even EPS. However, their cash equivalents now in the last 12 months, as you can see, have significantly improved. As a matter of fact, they're sitting at all-time highs. And their debt has also been reduced. So their balance sheet is actually a lot stronger now, even though their revenues have not recovered at an all-time high. And again, they will be in a position to achieve new all-time high revenues. They are now in a much stronger operation than they were before. And when you combine that with that stronger balance sheet, I think that's very, very positive. So other few reasons why I think this stock is going to continue doing well. In Q3 2024, and yeah, that probably explains that spike over here, right? They announced a new partnership with C.H. Robinson. Let's have a look at those guys. So what these guys are, they're a transportation company and logistics, right? And what this means is that very much Triumph Pay, which is the system that they provide, will become the standard payment system in the trucking industry, much like Visa and MasterCard became the standard for retail payments. And that's pretty interesting because at the moment, Triumph Financial as a standalone processes $24 billion in payment per year in volume, right? But this partnership is expected to add about 10.5 billion. So that's about a 45% increase, with most of the volume expected at the end of Q4 this year and into Q1 next year, with full ramp by Q3 2025. Good part of that revenue is expected to impact in the second half of 2025. And that achieves a very significant milestone for the company, which is increasing their competitive position in the market from processing 1 out of every 3 payment transactions to about 250% in a year. So that's very, very good progress, right? So with all those things, they expect that 2026, they will arrive at $1 billion in revenues. So you remember the numbers that we saw before, right? They're currently doing just about 400 million So they're basically saying that in a couple of years they're gonna double revenue, which for a market cap of this size is actually very, very good. At this uh, point of the life of the company, revenue growth is the name of the game. And they're basically saying that they're going to double that in a couple of years. So I think that's going to make the stock really, really hot, really in demand for the investors out there. But it gets even better because at the same time, they forecast 50% EBITDA margins across all the different revenue streams. So you get both a revenue story with an EBITDA margin story embedded into a turnaround. And that's one of the reasons why I think this idea would fit really well in the portfolio. Now, those are very good promises, but the fact is that management has actually been delivering already. So they have delivered EBITDA break-even ahead of schedule, and um, management has proved itself in terms of executing the plan that they brought in place. Now, of course, with every trade out there, there are risks. And some of those, as we saw, are beyond their control. So freight market rates, that's a headwind that could persist. Rate cuts, of course, also impact the business. They could come a little bit later than expected. Seems that they will. And there's still stagnant overcapacity, which is not that easy to predict. With macro, just very difficult to predict these kind of things. So as I said that right at the beginning, this is a trade that I would enter possibly around the very end of the year, perhaps even Q1 2025. At the moment, of course, if we look at this upwards channel that we have here, it seems that we are at the upper trend anyway, so it's not really a good time to buy. But as we come back to this standard moving average price, it would likely be the right time to do so. So possibly around the $80 with a price target of 100 to 120. And with this company, I think that the upside is actually quite large, especially when we look at the medium term. I think they're not improving the company full stop. I think they're making it bigger and better and a really established player to actually dominate the industry. They're trying to achieve milestones and standards that have not been done before. And that, of course, require a little bit of trouble and arrive. But the point is that I think there will be plenty of opportunities to get upside in stock. Onto the structure. As I mentioned before, this is something that I may look like down the line. I think that's the most probable scenario. But I actually had a look at the options market and I could find some interesting structures out there. So one of them could be buying the February 90 strikes and selling the 20 December strikes on a 2-for-1 ratio. That works, assuming a target price of 100, 110 can give us the profitability that we're looking for. Hope you enjoyed the video. See you soon.